Welcome to Market Call. I'm Morello Fernandez. Martin Cobb on the show today with us. He's Senior Vice President Equities at Lorne Steinberg Wealth Management. He's taking your questions today on global equities. Here's how to reach us. 1-855-326-6266 if you would like to call in. You can also email your questions. marketcall@bnnbloomberg.ca. Martin, thanks for coming in. Good to see you.
Hi, Marilla.
Let's talk about the TSX off the start because it keeps pushing higher and higher, record highs. What is your take on the enthusiasm here?
It's interesting. I had a dinner with my neighbours. I know the date because I was cooking haggis, 25th of January.
Okay.
I know. 25th of January, Robbie Burns Day. And the question I was asked by my neighbours is, why would you want to own the TSX? Why would you want to own Canadian equities, given all the fears over tariffs? Why not own the US? Here we are sitting today. The TSX is up nicely, and the S&P is flat to slightly down. And it's all to do with expectations coming into this. The fears were great, they were heightened, and here we are, and things are just... People are a little bit more optimistic. I wouldn't say optimism is prevalent of the day, but a little bit less fearful, perhaps. Maybe we're getting fear fatigue over tariffs.
Okay, so it's interesting because if some of that fear is passing, and this is a little bit of the optimism we're seeing, that bodes well for later in the year when we could see even more optimism.
I said before, and even last week when we were chatting, I do think we're still going to see some of the pain, some of the uncertainty. You know, unemployment numbers in Canada are likely to continue to rise. Mortgage resets are coming through for a number of mortgages, so people will be paying more on their mortgage. So there's still a lot of headwinds. But I think we're just saying, get that point of fear fatigue. All the nonsense about tariffs, people are just getting used to it and moving on with their lives.
Let's talk about the latest tariff threat from Donald Trump, of course, which was only on Friday about the EU Union, 50% markup. But then by Monday, it had been paused. Are you still seeing reaction to these threats in the market?
In the short term, certainly. I mean, you saw the markets are selling off or bouncing based on what is coming out of the mouth of the individual sitting in the White House south of the border. My longer term concerns, though, is some level of tariffs are likely to remain in place. It's a negotiating tactic. Ultimately, though, US consumers will have to pay more for products that are brought in from outside, whether it be from Canada, the European Union or Asia. And that's going to be ultimately deflationary because they're having to spend more for their toys, their baby products, and almost everything else.
Let's talk a little bit more about what you see for the end of the year. You said unemployment is likely to go up. Do you see excessive weakness in the economy? Do you think some of that weakness is going to be a little more balanced out than we thought it was going to be at the start of the year?
It's hard to tell. Don't try to forecast too much, and forecasting the economy is hard. But here we are sitting today just below 7% unemployment in Canada. It's slightly higher in Ontario, slightly lower in the rest of the country. Who's hiring today? Who's going out and investing in their business today, given all this uncertainty? And that's my greatest concern is we probably are in recession, or certainly GDP per capita is flat at best. So I suspect it's going to be a pretty tough gig for the Canadian economy, indeed the world economy, for the next several months and possibly into 2026.
Got it. All right. We are going to line up some phone calls for Martin Cobb, Senior Vice President, Equities, Lorne Steinberg Wealth Management. He's taking your questions on global equities. Here's how to reach us. We're back in a moment. Welcome back. Let's get to your questions today. The first one in an email from Brian. Brian says, what are your thoughts on Eel Financial? ELF. Tell me about Eel Financial.
Yes, it's possibly the most obscure stock on the TSX.
Okay.
Not many people have heard of it, but you've heard of its subsidiary Empire Life. They own Empire Life and also they have an investment portfolio which consists of internally managed funds, but also some holdings in closed-end funds. So United Corporation being front and centre. United Corporation is a what I call an investment trust. I come from the world of investment trusts in the UK. They trace their history back to 1926, United Corporation here in Canada. That's a relative minnow, a junior, because the investment trusts I used to work with, like Scottish American investment trusts, were founded in the 1800s.
Got it.
So what do? They have a fairly conservative, long-term, quality, highly diversified, quite international investment portfolio, plus Empire Life. And they've generated pretty good, solid long-term returns. I think their long-term annualized 10-year return is something like 9%, which is pretty good. You're able to buy it at a discount to its NAV today of about 30%, which sounds quite attractive, but historically it's been closer to 50%. Why? Because it's family controlled and run for the family. They're not great dividend payers. It's quite sporadic in terms of payouts. So whilst you're buying assets on the cheap, why is that 30% discount likely to narrow? Unless they break the company up and sell it off in its pieces, probably not. So yes, probably serve you quite well, but don't expect too much of a discount narrow to give you an extra juice to your returns like you've seen in the last few years.
Got it. Okay, let's go to the phone lines. Jim is on the line today from Elliott Lake, Ontario. Hi, Jim.
Good afternoon. Just a question here on John Deere, a very well-known company, probably not talked about as much on here, but your thoughts on it today, but maybe moreover, is this still a good entry point? It's made a big move here today.
Okay, John Deere.
Yeah, I grew up on a farm in Fife.
So you're very familiar with it.
I like tractors, yes.
Yeah.
We had the red ones, the Massey Fergusons, and the green ones, the John Deere. We have a problem with the planet, trying to feed the planet. We're going to be 9 billion souls at one point in time. We need better machinery, better crop protection, et cetera, et cetera. We own Corteva. We don't own John Deere, but we have exposure to the whole kind of agricultural sector. The need to grow crops, put tariffs to one side. This too shall pass. Ultimately, the problem is having to invest in producing crops to feed the planet, and John Deere is front and centre with that. Not just selling the tractors, the one I'd love to own one at home, to do my lawn, but in terms of precision agricultural. So they're really trying to lead the charge in how to reduce the amount of crop nutrients, etc., you can put in using big data. So they're at that edge as well. I was always a little bit worried about them in terms of their finance side. They're a bit like what the car companies did before the global financial crisis, making more money from lending effectively. They have reined that in somewhat, but it's something to keep your eye on. But John Deere for the next 5 or 10 years, good place to be because I like the agricultural dynamics.
Got it. Okay, let's go back to the phone lines. And Stan's on the line with a question from Ottawa. Hi, Stan.
Hi, thank you for taking my call.
Go ahead.
My question's on the Toronto Dominion Bank. I'm just wondering if you would be a buyer at this price. I know the issues in the U.S. are behind them now, and it's got quite a bit of capital saved up. And do you see it being a buy at this price? It's had a good run for the last few months, and will that continue? Thank you.
Okay, so it has come back quite a bit since December when it sort of fell off after what happened with the U.S. penalty. It did report earnings as well. Scotiabank reporting today as well. So what's your forward look on TD? Does it still have some recovery to do here?
Yes, simply on valuation. If you look at the chart, yes, it's been one of the best, actually the best performing bank year to date, but in 2024 it was the worst performing bank of the big six. So it had quite a bit of catch up to do. I think the point on the US, not quite behind them yet. They have to work through the asset cap. But what that means is they have limited growth in the US. And to touch on the caller's point about excess capital, if you don't have growth, you don't need capital. So they're going to be in a position where they can do something with that capital, either invest in Canadian business or, preferably, I think, buy back shares. So we like it. We own it. We will own it for the long term. Today, it's trading about 1.2, 1.3 times book value versus RBC, a better bank, yes, on 1.8 to 2 times book value. So it's trading at a big discount, roughly the same asset size as RBC, but 2/3 of the market cap. So we like it for the long term.
Okay, I think some people are worried that they missed sort of that first couple of months of the year where it was low and they meant to pick it up then, and now they're worried, should I pick it up now? Is it still worth having? Is it still worth growing over time? And you're saying yes, it will.
You never look in the rear view mirror in terms of what you should have done in terms of investing. I would have retired many moons ago had to be able to do that. You're paying 1.25 times book value for TD. They're cleaning up their act. They're doing some cost saving, investing in their anti-money laundering function. It will be squeaky clean before long. We like it for the long term.
Got it. Okay, let's go back to the phone lines. Rob's on the line today from Calgary. Hi, Rob.
Hi, thanks for taking my call. Sticking with the banking theme, I'd like to hear Martin's opinion on HSBC. I'm wondering if he feels that this bank is performing to expectations relative to its peers, or if he has a preference with other European, Canadian, or American banks. Thanks again, and have a good afternoon.
Thanks for the question.
Thank you. I remember HSBC when it was possibly described as the sexiest bank in the world.
Is there such a thing?
Yeah, I know. It's a fairly narrow universe in terms of that, but it was the growth bank. So it was the one that was always spending more, always investing and growing its capabilities. They came to Canada, then they retreated. They're expanding all over the world, and they'd be in kind of retrenchment mode. And increasingly, a bit of a European business, but it's the Asian business. The attraction of that is the growth. There should be better population growth, better loan growth, better economic growth, all that kind of stuff. But can they capture it? Because it's very competitive over there. There's a lot of big Asian banks trying to fight in the same place. And indeed,
where does HSBC fit into that?
It's one of the biggest.
It is one
of the biggest,
okay.
But you've got Development Bank of Singapore is a big one. Standard Charter, much more Asia-focused than them as well, smaller. But they've kind of retrenched to be that area. And there was some talk they maybe should relist in Hong Kong, get away from their UK roots, or even split the bank. So there has been some activism pressure upon them. But to answer the question, why bother? And we just talked about TD Bank. You can buy Scotiabank on 1 times book value, BMO on 1.2 times book value, in an oligopolistic protected banking market where returns on equity are super normal, 14, 15, 16%. I would keep my money in Canada.
Got it. There we go. All right, we're going to take a quick break. We will line up more phone calls for Bart and Cobb. We're back in a moment. Welcome back to Market Call. Martin Cobb is with us today. He's taking your questions on global equities as well as Canadian equities. Let's go to an email from Heather. She says, I'd like to get Mr. Cobb's thoughts on BHP.
BHP is the world's largest diversified miner today. That being said, it's not particularly diversified.
Okay.
About 2/3 of its profits comes from iron ore, about 25% from copper. So you're basically got those two metals. There's a real problem with, the extractive industries, it's a difficult in the sense that you're digging a hole in the ground and maybe 5 or 10 years later you bring the product to the surface and you've no idea what the pricing environment is going to be. You look at BHP themselves, they talked about the 4 pillars being iron ore, copper, metallurgical coal and petroleum. They decided to get out of petroleum, now they've got into potash because that seems a better long-term for them in terms of opportunity there. Looking at these companies, we're hearing today about seismic problems with Ivanhoe mines. We're hearing about problems with the Mali government for Barrick. Even if you can get the stuff to the surface, you don't know if you actually can keep the profits on it. So it's tough. It's tough. But I like their diversification. I'd like a little bit more copper, personally, than iron ore, which is more to do with the electrification of the world, less exposed to Chinese infrastructure, where iron ore is more exposed. But iron ore assets are in safer jurisdictions like Western Australia, etc.
I was going to say, where are they positioned?
Yeah. So copper's in nasty places in the world politically. I'm not going to in any way say anything other than that. But iron ore tends to be in places where you've got the rule of law. So that's something that's attractive. But they would like to diversify their portfolio. Everyone would like a bit more copper, but that's just hard to do. Today, you're paying 12, 13 times earnings for it. Nice, solid balance sheet, capital discipline, which I like. So not a bad holding to have, but it's just a tough industry. There's so much against you. If you get your timing right, you can make a lot of money. But it's long term, we'll need more metals. So not a bad place to be.
Got it. A lot of information there to unpack for Heather. Let's move on to the phone lines. Mike is on the line from Windsor, Ontario. Hi, Mike.
Hi. What do you think of buying Rheinmetall at these levels for a long-term hold? Thank you.
Tell me about Rheinmetall.
Rheinmetall is a company that no one talked about until about 6 months ago. It's the largest German defence contractor. Okay. Being a German defence contractor for the last 50 or 60 years has not been great because the whole kind of pacifistic constitution in terms of, and here we are today, given what's happening.
They're investing.
Exactly.
Yeah.
So they are, we've seen the German government breaching basically their fiscal rules to allow them to invest in getting closer to the NATO target or above the NATO target, 2.5%, 3% of GDP. So they'll be spending a lot of money, and these guys will be a key beneficiary of that. The only thing I would say is sitting here today, that's not lost on the market. So the valuation is looking a little bit excessive. So maybe there might be better opportunities when we're less enthused about defence spending to own this one. But for a long-term view, it looks like defence spending in Europe is here to stay. They will benefit.
Rhine is one of the bigger players. Are there other players in that sphere?
There are other smaller players, or there are some, organisations like Siemens, etc., have various divisions which are exposed to that. But this is the one. If you want to buy a German defence play, Rheinmetall is the one you would buy.
Got it. Okay, let's go back to the phone lines. William is calling. He's calling from London, Ontario today. Hi, William.
Good afternoon. Thank you for your past suggestions. I found they're very interesting. Do you have an opinion on which quantum stock to buy, please?
Quantum stock.
Yeah, yes and no. In terms of buying an individual quantum computing company, I think Alphabet is possibly the best positioned. But how significant would it be for Alphabet in the next 5 years? Not quite so sure. I would look to buy security companies. The one thing quantum computing is going to do, currently encryption uses basically prime numbers. And you have to try and work out what the two prime numbers are that make the product, and then you have to basically go backwards and then decrypt the thing. Very hard to do by conventional computers, and that's why it's so secure. Quantum computing kills that. It will be able to crack all encrypted sort of data that we've had over the last 30 or 40 years. So I would, in terms of playing quantum by the back door, I wouldn't be looking to really play it through quantum computing companies. Who knows who's going to win? Who knows how profitable these entities will be? But security, encryption, etc., is going to become much more important in the world of quantum computing, regardless of who actually gives us the quantum computers themselves. And
are there picks that you would go with specifically, or sort of any sort of recommendation or direction?
Again, you think of companies like Palantir, but 200 times earnings. There's a lot going on there, but I do think there's a number of security companies. Perhaps a broader, brush ETF might be better in terms of security companies.
Okay, let's go back to an email then from Barry. Barry is saying, wondering if Martin thinks Loblaw is a good buy. We'll pull up the Loblaw chart in a second. Grocers always sort of, especially in difficult times when the economy is weakening, will do well.
Yeah, Loblaws is a company we launched a Canadian dividend growth strategy in early 2020, and Loblaws was one of the 19 stocks that we purchased at that time, and we've held it ever since.
And what made you go to Loblaw?
Loblaws, one, it tends to have a portfolio that skews towards the harder discounter side, so it's well represented. It's the largest here, but it has that kind of more down market skew, which you thought would serve it quite well. Also has Shoppers Drug Mart,
yes,
which is absolutely
does well.
Does well, and then you have the likes of President's Choice, PC Optimum, that has some some bells and whistles around the overall thing. So we've held it over the entire sort of 5 or 6 years that we've had the fund. The only thing I'd push back on is, and we still will buy it for new clients today, is it's trading on about 23 times forward earnings. Historically, it's commanded 15 to 20 times. Maybe it deserves 20 times, but that's still lower than where we are today. So I'd just be a little bit mindful of the weighting you would have in the stock. We like the business. We like the long-term dynamics. We still own it. We still buy it for new clients and existing clients. We own it, as I say. But just be mindful that the valuation's a little rich, as it feels a little bit loved at the moment as a stock.
Got it. Okay, we are going to take another quick break. We're going to line up some more phone calls for Martin. We're back in a moment. Welcome back. Time now to take a look at Martin's past picks. They're from February 5th of 2025, so this year. And at the time he chose Saputo on the TSX, it was 24.03. It's gone up to 26.77, so 11% upside, 12% total return upside, and that's just in a few months. Why Saputo? What did you like about the cheese company?
It's a cheese company, yes. It's a branded cheese company, particularly here in Canada, in the UK and Australia. But its biggest market is actually food service, much less branded south of the border. Thinking back February, markets were quite high. So I recommend a cheese company, hip implant company, and a video game manufacturer, because I was fairly cautious on the overall market, and who doesn't like a bit of cheese? The reason Saputo is interesting from our perspective, we've held it for some time, is what's happened south of the border. Their biggest market, you've seen real compression in profitability. It's much more commoditized. The milk-cheese spread, pardon the pun, really has collapsed. There's overcapacity in the industry. So they'll have to work through that to some extent. They used to make 10% operating margins south of the border. Today, they're making losses in that area. So very simply, if they get back to halfway, 5% in the fullness of time, continue growth in their Canadians and international operations more on the branded side, the stock will look very cheap.
How does it do in Canada? You mentioned south of the border, the problems they have there. How do they do here?
Yeah, here's different. Down there's much more food service. So you're not going in getting a little red top tub of Saputo. So you come to Canada, it's much more retail oriented, which is typically much more stable. You've got a bit more pricing power, ability to pass through costs of milk, etc., to your customers.
So much more stable.
Yes.
Got it. Okay. You did mention your next pick, which was Smith and Nephew, which at the time in February of this year was $26.12, now up to $29. 06, so at 11% upside and 13% total return. And they do medical devices?
Yes, so they're one of the world's largest kind of hip and knee plant orthopedic companies.
Okay.
They also do advanced wound care, so really, really nasty wounds that comes from diabetes, etc. And they do sports medicine. We're probably more familiar with the likes of Stryker or Zimmer
Yes.
Biomet over here in North America. Smith & Nephew is very similar to Stryker, except it's trades, it's in the UK. Actually, it was set up by Mr. Smith and his son Horatio back in the 1800s, so Smith & Nephew, as a chemist shop. So it's been around for about 150 years. Trades on a big discount to Stryker, similar valuation, despite being a much better business than Zimmer Biomet. Just long-term aging populations. We're all getting a bit heavier, even with Ozempic. We're all getting a bit heavier. We need more hip implants, more knee implants, more, and so they're just serving that type of demographic. And sports injuries, athletic injuries, again, a growing market for their products. So long-term secular growth, very attractive valuation.
So you mentioned they're out of the UK. Are they have operations sort of everywhere? How far is their reach?
Yes, no, the US is about half the market for them.
Got it.
And then developed Europe would be, more than half of the rest. So yeah, but they are in Asia as well. But the US, as we know, is a big healthcare market. They spend a lot of money on their healthcare, and Smith & Nephew, Stryker and Zimmer all benefit from that.
Got it. Okay, let's get to your third pick, which was Electronic Arts. They do, I guess, gaming videos, that kind of thing. Recommended at $130.47, and now at $146.75. So 12% upside here, 13% upside. It's also done very well. What have they been doing right even in the past few months? Obviously, the stock has gone up quite a bit.
Yeah, I don't think they've done anything particularly right in the last few months. The stock just got hit a bit hard. What tends to happen with video game companies, less so today. It used to be much more boom and bust. You'd release your title just before the holidays and hope the Christmas sales would take off, your Call of Duty. Now it's a bit more utility-like, maybe a bit of a stretch to say utility-like, but they have a lot of sports franchises. And so they lost FIFA, but they have basically their own EA Sports FC. They have baseball, basketball, they have The Sims, lots of titles that are just around and get updated every year or every 2 years.
Does that mean it's steadier for them?
Yes, it's much so. If you look at them, they're more utility-like than your hit one-product companies that will release something like Grand Theft Auto and hope Grand Theft Auto 6 is going to do better than Grand Theft Auto 5. So I liked it because it has more of that utility-type nature to it, although it is in the video gaming industry, so there's still a bit of boom and bust. But if you look at their sales, roughly the same sales at Activision Blizzard, the market cap today is half what Microsoft paid for Activision Blizzard, what was it, 2 years ago. So it's a content play. Ultimately, it probably gets swallowed up by someone, Netflix, Amazon, who knows, Apple, and it could easily they would pay twice the price if we were to the same multiple that Activision had.
You mentioned some of the video games like Call of Duty, that kind of thing, which get a lot of buzz, right?
Yes.
There are a lot of followers, a lot of people waiting for that to happen. With the sports investment, do they get a similar amount of buzz, or is it much more niche and they're just sort of hitting pockets?
I think they get them in the FC Soccer, or it used to be called FIFA. The relationship with them and FIFA went back 25, 30 years. They broke apart. They decided not to pay FIFA. If you're friends of mine back in Europe, you all play EA Sports FC. You're all trying to get, we used to be Lionel Messi. I don't know who the player would you want in your team today, but you're trying to get, upgrading your team to get those type of players in. So there's a lot of microtransactions that take place. So it's less and less about the buzz of the new title, although people do go out and buy it or download it these days. They don't get the physical discs. It's more about the microtransactions of upgrading your team that drives that utility-like profit and very high margin.
Okay, it's interesting because I was trying to figure out how you make that money, but I guess you make it in increments, but on a massive scale. Yeah,
there was one, I think it was one here with Andrew. I talked about my son. I came home one day, my phone bill had all these charges for a game called Dragonvale Gems that my son had been buying, playing this game. 99.9% gross margins. I'm paying for it. Well, he paid for it, but yeah. So that is for these businesses. There's a lot of that these days, which is just profit flows straight through to the bottom line.
That's where they make their money. Yeah. Got it. Okay, we're going to take a quick break. Martin Cobb is sticking around. He's going to answer your questions on global equities as well as Canadian stocks. We're back in a moment. Welcome back, and thanks for joining us. Let's get to an email from Ashley. She says, could I please have your opinion of Atkins Realis on the TSX? We'll turn that over to Martin. We'll pull up the chart for Atkins Realis as well.
Yeah, Atkins Realis is, most people probably know it as its former name, SNC-Lavalin,
yes.
Which we know has had a bit of a checkered history.
And they've tried to turn the page.
They tried to, and they changed the name.
Yes.
So perhaps all will be good. I do like professional services companies, whether it's these guys, WSP, Stantec, you also have here in Canada. The reason why is I can't think of a world where we're not going to need less permits, less, studies,
engineers,
consultants, all this, having just built a house. Yeah, it's painful. So they're in that game. The one downside you have with these companies is they tend to have a bit of a construction, sort of background. And occasionally, CEOs decide, I can take a fixed price contract and really make a sweet margin on this, and it blows up the company. You can lose 5 years' profits in 1 year. They've been through that, so it looks like they're getting out of that. We'll do cost-plus contracts, try and make a good margin, protect the company. So I like where they're heading. The only thing is the valuation. I would have thought there'd still be some scepticism around the share price, but it doesn't appear so. They're on about a high 20s, almost a 30 times multiple. There's some strong growth. Their margins are about 8 or 9%, so they're a bit less than WSP or Stantec, which are low teens. But even if they get close to those levels with that growth, still be on 20 times earnings, 2027. That doesn't look too cheap to me. So not much of a margin of safety, although I like the industry, and the business does appear to have rectified itself.
Got it. Okay, let's go to the phones. Paul's on the line from Ottawa today. Hi, Paul.
Hi, I've been a shareholder of Visa for many, many years. I've actually jumped back and forth, Visa and then to MasterCard and then back to Visa. And I'm just wondering, its PE is, I think, around 36. MasterCard's is around 40. They're both really high up there. Long-term charts for both are amazing. But which one would you prefer, Visa or MasterCard? I'd be very interested in your evaluation. The business models are virtually the same, but I'm interested to see what you would think of either one and which one you prefer. Thank you.
So a couple of things to unpack here after you do your Visa MasterCard comparison, because I'm also wondering just about digital payments moving forward and the future for something like a Visa or MasterCard.
Yeah, and we can certainly touch on that. I think we may be splitting hairs here. I think flitting back and forth, good luck with that. They're great businesses, exposed to the whole move to cashless payments, which is still in some parts of the world got a long way to go. So you're seeing the sort of growth they enjoy is typical nominal GDP, maybe 5% global GDP, and then you add maybe another 5% from that move from cash to cashless. And they've both enjoyed that. MasterCard has enjoyed a little bit higher growth. It's a little bit smaller, a little bit more European, but there really is not much in it. They've both enjoyed very good growth. The margins are, unbelievable. 97% gross margins, 60% operating margins. They get knocked about from time to time, fears over regulation, but they only take about 1/10 of the interchange fee. So if you and I are shopping, we pay the 2.5%, or the merchant gives up 2.5%. Most of that goes to the banks. These companies are the facilitators. They don't take any credit risk. They're not banks. We like them for the long term. We own Visa. We could just as easily own MasterCard. Again, the long-term dynamics. The valuations are never cheap, but try and knock these guys off their perch. To your point about digital payments, the time of PayPal was going to knock these guys off their perch. PayPal ends up using their rails, their network, effectively. And I suspect we might have something similar again. There's a lot of flux with that. They've tried to buy some businesses themselves. They've been knocked back for antitrust reasons. But I just think you look at the world in terms of more cashless payments, long-term, population growth, spending, travel, etc. They're very well positioned. I prefer Visa slightly because of the discount, but there's not much in it.
Got it. Let's go to the phone lines then. Gulam's on the line from Toronto. Hi, Gulam.
Hi, good afternoon to you. My question is on Ivanhoe Mines. Recently, they had a seismic activity that slowed down their production. I like Friedland, and I wanted to add to my very small position. You think this is the right time to get in? And you see much further upside to that stock. I'd appreciate your opinion. Thank you.
Okay, so the seismic activity was in Democratic Republic of Congo. Yep. They had a problem a couple of weeks ago and then reported more activity recently. So they're changing up their production for the rest of the year, right? They're moving on that. So This is something we touched on earlier about how hard it is. The business is a hard business.
Yeah, so I've covered the extractive industries over the course of my career, and we talked about the pricing environment being out of your control, the political environment, whether or not, the resource capture will be by you or by, the national governments, which can change, on a dime.
All the time.
And here we are with seismic activity. It's just, so it is a tough gig. And I must admit, it's impossible to know how this will be resolved to some extent. Does the seismic activity go away, and are we back within several months to getting production ramping up again? I just don't know. So you mentioned it was a very small position. I do think having a position in extractive industries, in metals and mining, whether it be base metals or precious metals, does make sense. But I think we're playing a bit of speculation when you come into buying, Ivanhoe today. So you just don't know. It's in the too hard pile, in my view, and move on. But if you have a small position, I wouldn't necessarily make it a big position.
Just hold it.
Possibly, but you're playing a bit of a lottery. Is this going to be? Is the seismic? We're talking about the Earth's crust, and
we don't know what's going to do.
No, we don't know. So beyond my ken.
All right, Gulam, I hope that helps you out. Let's move to Frank, calling from Mississauga, Ontario. Hi, Frank.
Hi, thanks for taking my call. I'm trying to find a silver lining for BCE, and I'm doing some analysis and looking at south of the border what happened to U.S. carriers, especially AT&T and Verizon. I think they have gone through the same phase what Canadian telecoms have gone through because of the similar issues, minus the CITC regulations here. But do you think at some point our telcos will get their act together and focus? Because I don't believe this business is going away. Population is still growing. And if these guys can get their act together, reduce the debt, stop miscategorizing what they are actually going to do, and then just focus, do you think we're going to see the similar returns? Because since 2023, AT&T has doubled. It's sitting at 5-year high. So I'm just trying to find some silver lining.
Yep.
And trying to hang on.
Yep. You're not alone in that, Frank. So what is AT&T doing that the telecommunications companies here could learn from? I mean, different environments, different population. But are there lessons to be learned there?
Some, yes, some. I mean, I think the reason we've seen the returns, you almost answered the question for me. If they can do all these various things, we could do quite well. Expectations were very low. Here we are with very low expectations on Canadian telecoms. AT&T has simplified. They spun out their media assets. That helped to some extent. But understanding what your business does, focus on your core competencies. I was very disappointed. That they bought Ziply. BCE bought Ziply. And they justified it based on, well, the cost of capital was selling the stake in MLSE, and we're buying something here which is slightly more profitable. Well, hang on a sec, you could have bought back your own shares, which would be much more powerful. So, capital allocation is absolutely key. So they've slashed the dividend. That makes a bit of sense. But sadly, CEOs like to run growing companies. They like to have bigger companies and bigger paychecks. And I wish they would just focus on what they do. They have great media assets.
This is one of them?
Yeah, exactly.
This is our parent company, BCE?
And if they would just focus on paying down debt, at least they've taken that dividend albatross off their back, so that's a good thing. But the point I think the caller made, expectations amongst investors are pretty low, and it feels at some point, they could rise. And the competitive environment probably is going to get easier. It's been tough after the Rogers Shaw deal and the competition we've seen. And population growth, it will continue. So, they're maybe not at the point of maximum pessimism, but they're down there.
Got it. All right. We are sticking around here with Martin Cobb, Senior Vice President, Equities at Lorne Steinberg Wealth Management. He's taking your questions on global equities, including Canadian stocks. Here's how to reach us, and we're back in a moment. Welcome back. Let's go to Kareem. He's on the line from Ajax, Ontario, with his question for Martin today. Hi, Kareem.
Hi, good afternoon. Thank you for taking my call. My question is on Aritzia, and I would like to get your guest opinion if you would consider this stock as a buy, hold, or a sell at this point. Thank you so much.
Thanks for the question. It was funny. Aritzia came up during the whole initial tariff discussion because it was questioned as to where they get their product from, and they seem to have bucked the trend, right? Their supply seems steady, and they seem to be doing really well and growing.
Yeah, no, I like Aritzia as a business. I mean, apparel retail is a graveyard, as we're talking about, in terms of companies that have just disappeared. Obviously, Hudson Bay does a bit more than apparel, but it's a tough gig. Aritzia, my experience is sitting on the sofa as my wife and my daughter go shopping, and it's great. It seems to have really positioned itself to be not fashion-driven, but to be a little bit fashion-driven, but offering something that a whole span of age groups. So my daughter, who's in her 20s, can go there.
More
of
a staple.
More of a staple, yes. I'm not going to mention my wife's age, but she can go there.
Yep.
And I think as long as they keep that, it's hard work. You have to be offering product, replenishing that product every few months to make sure you're at the right edge. They compete with the likes of H&M, etc. But they seem to offer, a reasonably good product that is defies the ages to some extent. So, long-term holding, well-run business, reasonable valuation.
Got it. Okay, let's go to an email then. This one is from Dion. He says, "Good day, Martin. Thoughts on Disney stock? It's basically been sideways since 2022. Disney's had a lot going on. They recently brought back their old boss, I guess. So what are your thoughts on Disney?"
Yeah, a lot going on with Disney, whether it be, CEO changes, whether it be political issues.
Fights with the state.
Exactly. So, but what is Disney today? It's obviously the entertainment business, the parks, the cruises, which is about half. Then you've got the films and you've got streaming. It wasn't that long ago, about 3 years ago, when the stock was almost double where it is today, and everyone thought they were going to make a fortune in streaming. Well, I think the reality is now set in. But they are going to be one of the long-term winners in streaming. Their product is in terms of the content, is arguably unparalleled around the world. The parks business, I remember going to the parks in March of 2009 down in Florida, and that was the depths of the global financial crisis, and it was full. It just shows you the power of Disney and the experiences. So you have international expansion. We've had Tokyo, Shanghai, Abu Dhabi's coming. I just think it just ticks so many boxes. We've probably seen peak Marvel, but they have such a long catalogue of titles from Lucasfilms, etc., the Star Wars. They've got everything. So Disney will be around for a very long time. If they can sort out the management, keep the businesses ticking over and making nice profitability and drive the streaming towards profitability. We're now in profits, but good profitability. They should be able to get back to 20% margins. That's a pretty cheap stock if they do.
Got it. Let's go to the phone lines. John's on the line from London, Ontario. Hi, John.
Hello, Martin. I bought ARM Holdings, the chip maker, at its IPO. It did well. It pulled back, but it's still strong growth, good profitability, and it's based in the UK, which is a reasonably civilized part of the world. Should I hold it or add to it, or is there a faster horse in the race? Thanks very much.
Yeah. ARM Holdings, interesting. You bought it at the IPO. I bought it at its previous IPO. We're talking a long time ago in the UK when it came to the market as a small cap, technology stock. They provide chip designs, so they don't do any manufacturing. They provide their designs largely for mobile, it's very low power consumption type designs, and they've been phenomenally successful at it. So you'll have maybe 1, 2, 3, now 4, ARM chip designs in an iPhone. So I like the business, long-term designs. It's just the valuation. I just struggle with it. They need to continue to have the level of growth. And there are a lot of players who are getting involved in chip designs, including some of the big ones like Microsoft, Amazon. They may be focusing more on the high-powered chips, but it is a very, very, competitive space. They've got their niche. I find the valuations a little bit expensive, but great technology, great company. UK is reasonably civilized, I would agree, but the valuation demands probably a lot more than maybe they're going to deliver, unfortunately.
Got it. Let's get to one more phone call before we have to take a break. John's calling from Brantford, Ontario. Hi, John.
Hi.
What's your question?
I wanted to ask Martin about Vodafone. It's gone up like 20% in the last 3 months. Do you think it can go higher? Thanks for taking my call.
Okay, let's pull up the chart for Vodafone.
Boy, there's another blast from the past. I remember when Vodafone was, I believe, the largest company in Europe, and certainly one of the largest in the world, at the height of the technology and media and telecoms boom. They bought Man of Germany. They were embarking on world domination. didn't work out. So they've retrenched, and it's very similar to the question on BCE or AT&T to being, a utility-like business, like what telecoms used to be, utility-like business, struggling for growth. You can maybe increase your subscribers, but you give that away in terms of, competition on pricing, etc. So average revenue per user, it just kind of flatlines to some extent. So I think it'll give a reasonable yield today. I don't know what the exact number is, but don't get too excited about it. The times of telecoms being great businesses with lots of growth are past.
Got it. All right, that is all the time we have for phone calls and emails today, but don't go away. Martin's going to share his top picks. That's coming up. Welcome back to Market Call. It is time now to take a look at Martin Cobb's new top picks. His first one is Tektronic Industries out of Hong Kong, and they do essentially floor products. But
power tools and floor products is a tiny part of the business. Power tools. So Tektronic is a company that I've followed for 20, 25 years, owned it for 15, 20 years. And one of the very first stocks I bought for the global equity portfolio when I joined Lorne at Steinberg Wealth. They own Milwaukee Power Tools and Ryobi Power Tools. They dominate, respectively, the professional tools market in North America and the DIY enthusiast market in Ryobi in North America, about 75% of their business. They do have floor care products. They own Hoover, the original kind of verb, and Vax, but they don't make much money. The real attraction here is the power tools business. They have enjoyed market-leading growth for a decade or two now, and typically north of 10%, and incrementally improving margins. One of the cleanest set of accounts I've ever come across, no exceptionals. Net cash balance sheet, 20+% owned by the founding family, the Pudwells. Just a great business, delivering something like 15% earnings per share growth. We're paying 16 times earnings for it for two of the best brands in their respective categories, driving the whole cordless market. If it was listed in the US, I think it'd be on 30 times earnings.
Wow.
So, there is maybe a discount for domicility. I don't mind that.
I was going to say tariffs would be the question. Are they exposed to that?
Interestingly, if we go back several years ago, the first round of tariffs, when he was the 45th president, they moved quite a bit of their production capacity to the US and Mexico. So they have the ability to do final assembly. But yes, all companies will be affected to tariffs to some extent. It's hard to make batteries outside of China. So there's always parts, and they're quite valuable parts of it. But they will navigate that. But so is the competition. DeWalt on the professional side, Stanley Black & Decker on. They will navigate that. But these are just, if you walk into Home Depot, you have the banks of red and the banks of lime green. That's Tektronic.
Got it. All right, let's go to your next pick, which is Alphabet, which is parent company of Google. Of course, what do you see looking out for them? They're facing a couple of lawsuits or Department of Justice actions in the U.S., so there are questions about how that's going to shake out. But what do you like about Google or Alphabet looking forward?
Yeah, the breakup potential is something that I really turn a blind eye to. If we were to break up Google or Alphabet into its constituent parts, and the valuation you put on YouTube, the valuation you put on the AI business, on search, I think it'd be greater than the sum of the parts today because the stock is trading at such an attractive valuation. The great fear is over search. I know as a user of search, I use ChatGPT, DeepSeek, or Gemini, their own product, much more than I use Google search. But if you actually drill down, about 55% of Google or Alphabet's revenues come from the search product. If you drill down into that, the area that really informational and commercial search is only about 40% of the revenues there. So maybe we're looking at about 25% of their search revenues being at risk over the next 5, 10 or 15 years, of which they will take a chunk of the market share, perhaps not the 90% market share they enjoy today. So it's a bit of a headwind. But then you look at YouTube, you look at Android, look at their cloud business, which is growing faster than Amazon's and Microsoft's Azure, and is on margins today which have room to double or even treble to get close to those levels. So there's lots of things moving on. The fears over AI and large language models hurting them, I think, is excessive. You're paying 17, 18 times earnings for still a business that's offering double-digit earnings per share growth.
Got it. Let's get to your third pick then, which is classic Canadian natural resources. Tell me why you like Canadian natural resources moving forward. Is it sort of the big push to support energy now in North America that you're seeing, a new government that says it's going to be more energy friendly? What do you like about CNR?
That will probably help at the margin. I'm sure you've had experts on this program who've talked about pipelines and the capacity and what they could do to narrow the discount, etc. But really, I'm much simpler. I was an energy analyst. I ran the Templeton energy team for several years. And what do I like about my energy companies? I want low cost of production. In 2020, WTI averaged $39 per barrel. These guys still were free cash flow positive because of low cost of production. I like to have long reserves. Their average reserves today are 33 years of production. I like to have low decline rates. I mean, their mining operations have 0% decline rates, but their average decline rate of the portfolio is about 11%, which is quite low today. And finally, I like capital discipline. I really like capital discipline in this industry. And they have communicated very clearly what they will do to pay down from the recent deals and return cash through dividends and share buybacks to shareholders. Ticks all the boxes for me.
Okay, so do you see any exposure to uncertainty given what's happening in the U.S. and threats to sort of cut off Canadian energy and all that kind of rhetoric we're hearing?
Their threats, it's just completely unrealistic. So the US is not self-sufficient in oil production. They produce roughly 13 million barrels. They consume 19 to 20. There's a gap of 6. 4 million barrels per day is provided by us, of which C&Q is a major contributor. If you're a refinery sitting in Chicago, how are you going to get your oil if you're not going to get it from Canada? It's as simple as that. They need our oil. OK, maybe they were a 10% tariff, maybe it'll go up higher. I don't think it probably will go up higher. But who knows? I don't want to get in the mindset of that. But Canadian oil is desperately needed by US refineries in the Midwest, and there's nowhere else they can get it.
Got it. Martin Cobb, got to leave it there. We're out of time. Thank you for your time. And thanks for joining us on Market Call. We'll see you again tomorrow. A quick look at the markets as we head to a break.